Investors, it's been an incredible 3.5 months. We've had a V-bottom rally in stocks since peak market fears over economic uncertainty caused by the Liberation Day tariff spreadsheet chaos in Trump's administration. The administration has walked back some of the most draconian tariff levels touted by Peter Navarro, even seeming to play nicer a bit with China on many points. Investment team at Oak Harvest Financial Group discussed the likely V-bottom in stocks mid to late April, well before the historic rally took hold, while many others were talking doom and crashes. We discussed for weeks in our videos, looking back on April 7th, what we thought was the low for the overall S&P 500 index and U.S. stocks, most likely for the rest of 2025, except for maybe the unforecastable black swan event. Investors, we thought the minus 20% bear market correction was largely an event induced by President's unforeseen tariff policies. Investors, real good news is that we V-bottomed, and this V-bottom happened without the Federal Reserve intervention and interest rates being cut. More Fed rate cuts are in front of us. What's their timing? I'll let the academics, economists, strategists, and financial commentators and social media discuss that one ad nauseum, discussing irrelevant things in my view, such as dot plots and Fed funds futures. Chris, irrelevant? How can that be? Because I've said for the better part of 5 years, they have near zero predictive power in detecting the level of future interest rates. Study after study of data says that the Fed is a momentum investor. Cuts beget cuts, and their timing is much less important than most think. Direction first. Think investors, we're at marginal new all-time highs in stocks, and the Fed has paused. Think about that one. All those bear calls for a market collapse as the Fed reduces its balance sheet. Remember those smart calls 2 years ago? Those calls that the stock market was near perfectly correlated with the Fed's balance sheet expansion? Well, we're near 62.75 on cash S&P 500 as I write this, and the Fed's balance sheet has shrunk by $2.5 trillion since they started quantitative tightening. So investors, now sitting here in late July, I've been flooded with bullish pieces, written largely from those who missed the near 4-month V-bottom rally, discussing the wonderfully positive seasonal tendency of July to be the second best performing month of the year. I'm here to bring you good news and bad news. First, the good news. Investors, we're in a bull market. Against the bear calls from imminent collapse like Jeremy Grantham, amongst others for nearly 15 years, against the retired hedge fund billionaire calls for a looming debt implosion, or championing the beauty of the Chinese economy, Ray Dalio for the last 12 years by my count, and against the most recent calls for an inflationary spiral caused by tariffs, we're in a bull market, plain and simple. If you got scared or pulled the plug for emotional reasons, it might be time to enlist a professional money manager or at least a financial planner such as Oak Harvest to help determine if you're allocated too far over your skis versus your risk tolerance or against your needs. In simple terms, let us help you determine a plan that meets your needs first and your greed second. If you didn't get scared out, congratulations. You might be with a good planner. You might have a strong self-directed plan, or maybe you were on vacation. We're in a bull market up and to the right. Breadth has been strong. Forget those naysayers who keep telling you it's only 5 or 10 stocks in the markets, that it's only Nvidia or Netflix or Microsoft. They've been wrong and have likely been wrong for months, if not longer. The naysayers who keep trying to scare you about this interest rate above this level or that level being the key, well, they've likely been wrong too. Interest rates have been in a range and been bouncing around. But Chris, interest rates have been so volatile. China is dumping U.S. bonds, so I read, as are all other countries I hear about on TV. Possibly, but I'm sorry, the data says otherwise. Bond volatility has been declining, not rising. The best proxy I've found about bond volatility is the MOVE index. We've talked about this one before. In fact, discussing it long before most on TV. Why? The MOVE index measures long-term Treasury bond volatility. A high level or higher trending number equals more bond volatility, which means many market players have to delever. They have to sell assets. They have no choice. Their brokers tell them this. U.S. Treasuries are the safest collateral in the world, but if their price is moving too fast, you must deleverage. No ifs, ands, or buts. Here's a chart of the MOVE index. In this chart, like most things in the bond world, it's opposite of a stock chart. Down and to the right is good, and up and to the right is bad. The circles are the Fed rate cuts in 2024. Right now, the way I see it, the overall trend is lower, which is good, but we're now on support, which is not so good, particularly entering in a seasonally weaker time of the year. This, coupled with a likelihood of a small pickup in inflation the next couple of months caused by the lag effect of the Trump tariffs, should make one slower to put new capital to work. Here are charts of the longer-term 10-year inflation break-even rate and the shorter-term 2-year inflation break-even rate at between 2.42 and 2.45%. Neither is horrible. Recall, historically speaking, 2 to 3% growth, 2 to 3% inflation is Goldilocks. Ideally, 2 to 3% growth and 2% inflation would be nicer, but we sit a bit higher currently on inflation and a bit lower on growth. I would expect to see a slight uptick in the inflation figures over the next 3 months on the good side, and many in the higher inflation camp for longer hysteria camp hit the media hard in August and September. Just as stock buybacks slow, inventory has been replenished in front of back to school and Christmas. However, everything I hear and see suggests that deflation is taking place in the U.S. housing and rental markets. Renters I talk to are actually upset about signing leases 1 to 3 months ago and are now seeing the same apartments for 5 to 10% less. Homes in the Houston area are sitting on the market longer, and regardless of what most agents are telling you, the markets are slow and soft for sellers. Which leads me to the number one area and likely reason for a very normal summer stall, or likely minus 4 to 6.5% retracement sometime between mid-August and mid-October. A further growth slowdown looks to be approaching. Tariff-induced, demand pulled forward, uncertainty upticks, inventories replenished, and the normal time when there's almost nothing a bullish investor can do to offset a negative story and bearish swirl. Here's the real-time 2-year Treasury TIPS yield. I call it the real growth yield. It's the premium investors demand for holding treasuries. To me, it's a measure of growth, not the measure of treasury risk that many on TV like to spin it. Investors, look at this chart in the last 24 months. When did real growth peak? It first peaked in mid-2023, which was the confluence of the end of the COVID-induced government giveaways and the start of the Biden administration call for IRA spending. It then peaked again in summer of 2024, which was peak Biden IRA fiscal spending in front of the 2024 presidential election. It was relatively stable at around 1.75% into year-end 2024 post the election, till the Trump administration decided frictionary tariffs and trade were their leading issues, not investor-friendly taxes and deregulation. So investors, when did this number trough? Yes, near spot on the first week in April when the administration started to walk back its initial draconian tariff game plan. This was one of the most important real-time data series I was watching that got me confident in our V-bottom, no one gets in call back near tax day. Investors, the problem now? It's rolling over again, just as 1, we enter a seasonally weaker time for stocks. 2, investors will have a hard time combating the demand pull forward talk that should build over the next 4 weeks. And 3, the administration ramps up tariff talk again. I mean, really, we neither saw nor heard from Peter Navarro on CNBC from April 7th till July 10th. These are good reasons behind last week's title, Nothing But Net, because historically, if you left town after the first 10 trading days in August, didn't return until the first 1 or 2 weeks of October, you would miss nothing net. Instead of getting FOMO, fear of missing out here, how about taking a deep breath, exhaling, and slowing down and thinking, if early August through October tend to be stalls at the market at best and down most years, what do I want to wait for to buy in the third quarter slowdown? Whether it's caused by a minor uptick in inflation from tariffs or a slowdown in the real economy due to a pause in demand after a pull forward of inventory building and pull forward of buying in front of those tariffs, what stocks and groups would I want to own on the other side of a late summer and early fall? Hence, Nothing But Net for last week's title. Investors, we don't expect a summer squall, but we do expect higher levels of investor frustration over the coming 3 months. And yes, even during the dot-com run, 1998 through 2000, there was a period of about 3 months after the initial 4-month V-bottom post-long-term capital markets blowing up, where the overall S&P 500 churned without getting burned. Here's that update overlay then and now. Investors, the pattern remains bullish, and up and to the right is good. New all-time highs are not bearish historically. However, after rallying for almost 4 months off the April lows, exactly 4 months is in between August 4th and 8th, I do not expect the pace and percentage gains of stocks to continue at this rate. Expect the pace to slow. Investors, we expect a normal late summer pullback in the markets. If this plays out as we expect, our team is stuck with their 2025 year-end target of 6,600, even as stocks sold off into April, and most strategists slashed their targets from over this number to the low 5,000s and are now raising them once again. Does that mean you shouldn't add to stocks, particularly if you're younger and in saving and accumulation mode? No. Rarely can you pick the absolute level on both price and time, on both the buy side, the sell side, and the buy side once again, particularly in growth stocks, as we've covered in prior videos. Investors, regardless of the path for the economy and the financial markets over the next few months into the end of summer and early fall, the investment team at Oak Harvest will be here, crewing the ship and adjusting our models where we can. Until next week, have a blessed weekend and know that the Oak Harvest team is doing what we can to plan for you and your family's future, regardless of what stage you're at in your career or in your retirement.